Hello, my name is Janisa Eubanks, and I would like to welcome you to Group 3's presentation. Gabby, Dana, and I are excited to have an opportunity to present our findings and recommendations. Today's presentation will include background, industry overview, SWOT, strategy, the numbers, our recommendations, and key takeaways. The industry. The economic outlook for linear board industry is positive due to the strong demand and limited supply. Economic analysts predict that linear board prices will reach 420 million by the end of 1986, even though only 1 to 2% new capacity is expected to be available due to the rising product demand. This demand will cause the industry to operate close to 100% utilization. We believe that companies who increase their linear board production capacity will position themselves to sustain long-term growth and have an opportunity to attract new customers. SWOT analysis. In order to identify the most critical factors that are key to the success of Atlantic Corporation, we conducted a SWOT analysis. Major strengths identified include size, diversity, locality, and industry recognition. Major weaknesses include linear board capacity, dependency on competitors, and inability to identify willing sellers of assets. Opportunities identified include increasing linear board capacity, increased profits, and narrowing the gap with competitors. If there is a delay in action, Atlantic Corporation may be succumb to the following threats. Hostile investors may take over Royal Paper and decide to not sell assets, and linear board prices will increase, resulting in higher costs, and current capacity would not allow them to keep up with customer demand. Industry forces. To support our efforts of understanding the factors that shape competition in the linear board industry, we suggest using Porter's 5 forces to provide insight. We found the threat of new entrants to be low, as there are high costs for startup and entry into the linear board market. One area where risk is considered high is the bargaining power of buyers. Customers have a lot of power in this industry, as they can easily switch to a competitor if their needs are not being met. The intensity of competitive rivalry is considered to be intense, as the companies in this industry produce the same or similar products, and there are a large number of firms varying in size and production capabilities. When it comes to the bargaining power of suppliers, firms in this industry place value on supplier relationships. Prices are competitive, but due to the shortage of material suppliers, they have power on the cost of materials. Lastly, we deem the threat of substitutes to be low, as customers are not likely to switch to an alternative product. It is concluded that Atlantic Corporation technically competitive advantage is weak in its current state due to a low credit rating. Currently, it also has the lowest stock price in the linear board industry.
Atlantic Corporation is needing to expand their facilities in order to increase their production of linerboard. Atlantic has considered building a new facility that could produce 2,000 tons of linerboard per day, or 730,000 tons per year. This new linerboard mill would take up to 2 years to build and could cost Atlantic $750 million. Even though the facility would have a lifespan of 30 years, Atlantic cannot justify spending that amount for a new facility and must consider other options. Halloran has reached out to Winters inquiring about the purchase of assets from Royal Paper. Those assets would include the Monticello, Mississippi linerboard and kraft paper mill and 16 box plants. Halloran is willing to offer up to $319 million to acquire those assets. The Monticello, Mississippi mill was built in 1968 and produces 661,000 tons of linerboard per year. There are plans to modernize the plant at a cost of $70 to $80 million to increase production to 747,000 tons of linerboard a year. Included in the acquisition from Royal Paper is 16 box plants. These box plants are in the South, Midwest, and East. Atlantic currently has its own box plants located in the West, South, and Midwest. If the Royal Paper box plants are acquired, then Atlantic could have box plants dispersed throughout the country, closer to the end users. This could reduce shipping time and cost for the end users and increase customer satisfaction. Using the planned capital expenditures and forecasted net working capital, we were able to calculate the net cash flow from 1983 through 1993. Atlantic's bond current yield to maturity was calculated for the after-tax cost of debt. The after-tax cost of debt using the tax rate of 36% is 8.58%. Using the capital asset pricing model, we calculated the cost of equity. The cost of equity was calculated to be 18.99%. The weight of debt is calculated using the current market values in 1983. The market value weight of equity is 53.3% and the weight of debt is 43.8%. We were able to calculate the weighted average cost of capital at 14.44%. The WACC will be used to calculate the net present value to determine how much the Monticello mill and the 16 box plants are worth. Using the WACC and discounted cash flows, we calculated that Royal Paper's assets are worth $234.27 million. Halloran is willing to offer up to $319 million for the Royal Paper assets. Based on the NPV, we have determined that the paper mill and box plants are not worth that amount, and Halloran should reconsider his offer. Due to the age, value of facilities, and the need for upgrades, if Halloran places an offer for the assets, he should not offer more than $225 million. Atlantic is considering three options for financing from different sources. Those three options are drawing on its bank credit line of $200 million with interest at the prime rate of 9.25% plus 1.5%, issuing up to $400 million of 25-year debentures at a yield of 10.25%, or issuing up to $300 million in common stock at an estimated price of $30 per share with net proceeds of the company of $28 per share. All three options provide positive benefits, but they can also cause concerns. A Fricto analysis has been completed to compare the three options. Out of the three options being considered, the most flexible would be the issue debentures up to $400 million. As long as Atlantic continues to have good credit, they would be able to issue debentures. The bank loan of $200 million would be the second most flexible option. Banks would look at current assets and base their loan on what they believe the asset is worth. The least flexible would be the common stock. It allows Atlantic to raise the needed capital once in the initial sale, but any future sales of stock would not provide any profit to Atlantic, but would benefit the stock owners. Common stock is the least risky of the three options. If the company has financial trouble in the future, they are not required to pay common share stockholders dividends. The option with the second highest risk would be a debenture. A debenture is a type of bond, and a company does have the option of defaulting on bonds. The riskiest option would be the bank loan. The company would be required to pay the bank back for the amount of the loan or declare bankruptcy. Common stock will allow the company to generate income. And as the stock matures, the stock can increase or decrease in value based on the stock market and how the company is doing. The bank loan would provide the initial capital that is needed, but would leave the company in debt. The best option to create the value would be the debentures. Like common stock, debentures mature with age, but they do not rely on the stock market for their value. Debentures can also be bought and sold, and Atlantic is willing to sell up to $400 million in debentures. If Atlantic decided to issue common stock, the owners of the common stock would have voting rights, and Atlantic would no longer have full control of the company. This does allow for the possibility of a takeover in the future. Both debentures and the bank loan do not provide voting rights because they are creditors to the company, and Atlantic would maintain all equity in the organization. The returns on debentures have increased compared to previous months, but they are still below the average returns from 1979 to 1981. Debentures are predicted to decline in the future. Selling common stock or drawing on the available bank credit would be better alternatives than debentures. During this time, the stock market is trending to be stronger than previous times, and bank and corporate interest rates are starting to decrease. Based on the Fricto analysis, we believe that common stock will be the best financing option. Common stock provides the needed financing up to $300 million. It does not accumulate debt and does not require payment of dividends. Even though common stock provides voting rights and a risk of takeover like previous times, with the stock market trending up, we believe we can provide dividends to the shareholders that will keep everyone happy.
There are four different types of dividends: regular cash dividends, extra dividends, special dividends, and liquidating dividends. It is essential to understand which type of dividend is suitable for this particular case. Regular cash dividends are most common and they're paid out quarterly. Extra dividends are given to stockholders and a part of the payment is considered to be extra/, more than normal. This payment may or may not be awarded again in the future. However, special dividends are a one-time special amount and they're typically unusual and not given again. This amount, however, is comparatively large. Liquidating dividends are provided if the company decides to liquidate. We can automatically assume that this would not be a suitable option for this particular case. Dividend suggestion. We suggest that Atlantic Corporation opts in to provide an extra dividends to their stockholders along with increasing their dividends. This amount can be set by the corporation based upon their financial stability. The extra part may or may not be paid out again in the future. The hope is that there will be extra funds available after opting into one of the financing options. While the main priority is to gain capital to purchase royal papers, it is important that the stockholders are happy during this new venture. Now that we have determined the type of dividend that should be issued, we must keep in mind the time of the dividend payment process. This information would be helpful to track to determine if the corporation could afford to pay it at the time selected. Since extra dividends are provided with a surplus of additional income, the company will have to determine if they will be able to pay this amount after they choose their finance option or before. This could be possible considering that they could finance through common stock. Common stockholders are not obligated to receive dividends like preferred stockholders. Also, with the timeline of payment, there is a cutoff date on who has invested in time to receive a dividend. As you can see, the four main processes of the dividend timeline payment is the declaration date, ex-dividend, record date, and payment date. Dividend policy. Dividend policy is the time pattern of the dividend payout. In particular, should the firm pay out a large percentage of its earnings now or a small percentage? This is something that Atlantic Corporation would need to reflect on. While it's unknown to us, Atlantic Corporation should ensure if the company has a dividend policy. While to some the dividend policy is irrelevant, the company should abide by what is outlined in their policy. Clientele effect. Surprisingly, Atlantic Corporation will have to determine how much extra they should provide to their stockholders. Not every shareholder would prefer a large payout due to taxes. By paying the stockholders dividends, this is considered income and must be reported. Some stockholders will prefer a smaller payout that does not impact them when it comes to filing their taxes at the end of the year. Since extra dividends are like a surprise, it does not prepare the owners enough time to make adjustments if need be. Non-cash dividend options. If Atlantic Corporation is stuck between the amount to pay, there are alternatives to cash dividends. Stock repurchase is an option, and this allows the corporation to participate in something called buyback. With the repurchase, it will lead to higher earnings per share and decrease in outstanding shares. Another dividend option is stock dividend. This is not a cash dividend, but it will increase in the number of shares that the stockholder owns. Stock splits are very similar to stock dividends, but this splits up the stock and create more shares. We have recently seen this happen with Apple Inc. Stock splits and stock dividends, however, decrease the share value. While these options are less likely used, there is an advantage of increased shares outstanding. This option is provided just in case Atlantic Corporation decides to use their capital elsewhere and does not have the finances to pay the extra cash dividends. One tip that we have for the future as it relates to dividends is buyback stock. While this is something that may not be done immediately, we think that it would be a good option to buy back stock from its shareholders in the future. This is another one of those perks in financing through common stock. This will also generate more revenue for Atlantic Corporation in the future. In conclusion, we have 5 key takeaways. One, we understand that it is important to understand where the firm is compared to its competition. Two, we decided that common stock will be the best option for financing. Three, absolutely, we should secure stockholder support. Four, we're going to do this by increasing dividends in the method of extra dividends. And five, we decided that in the future it would be good to buy back stock from its stockholders.